couple of value stocks here that are somewhat similar that our value stock strategist Tracey Ryniec wants you to know more about. She's with me here now to tell you more about them. The similarity comes in the product line for these companies, yet still different too.
Right.
So you've got Energizer Holdings, which is batteries, right? The Energizer Bunny, everybody recognizes. But also personal care products. What's up with that?
Most people don't know they have that secondary segment of the business. I didn't really think about it until then. I was like, oh yeah, they own all these other things. And actually, those other things are a bigger percentage of their overall business than the batteries are now. But the personal care items are like Playtex, they own that brand. Binkies, the pacifiers that little kids use. Wet Ones, that's a personal favorite of mine.
That.
No. They own Schick too, which is like the shaving line. But they are in that's a tough area, the personal care, because there's a lot of competition. Schick is a well-known brand, but it's going up against Gillette. Same thing with a lot of their other products. So, they've been cutting a lot of their costs. That's been a good thing. They did have a big beat last quarter. They reiterated full year guidance. That's also a good thing. The battery side of the business has been kind of dead. They've been trying to fix that, grow that. They're in Walmart now. So some of these things are going to help them going forward. This is the kind of company you buy because not, that it's growing like by leaps and bounds, but it's just kind of a steady eddy. And they're expected to grow earnings about, double digits, low double digits this year and next year. You're getting some growth, but you're going to get the value, and you get a dividend. They pay 1.6%, which isn't like on the high end of things, but you're getting something to hold on here. So the analysts kind of like what they see here. You got the estimates starting to trickle up. They're not, again, going to jump, extremely fast up, but they're starting to move up because the cost cutting and some of these other things that they're doing, and they do have the good brands. So, shares didn't do anything for like 5 years. But in this year, 2013, they started moving up. They've had 3 beats in a row. They've done the cost cutting, like I said. The analysts like them because they're on the cheaper end for the personal care products segment. They're trading around 14, little under 15 times. So not super cheap anymore, but compared to some of their competitors, it's a good value stock.
Okay. This other company, Domtar Corporation, they've got 3 segments, and this is really diverse. Paper, pulp, and personal care again.
Yes.
How does that work?
I don't know. I don't ask the questions. I just kind of try to figure out what it is they do. But for them, their personal care is the smallest part of their business. So the paper and the pulp are about 80% of their business. A lot of it is dependent on prices for both the paper and the pulp. Pulp prices have been kind of holding their own, and some people are kind of surprised by that. In May, the pulp volumes rose, but the analysts don't expect that to continue in the second half of the year because China is weakening. China's destocking their inventories, and then they have their own economic problems going on over there. So with pulp prices, if they come down a little bit, this company is very open to any paper and pulp price changes. But on the personal care lines, they actually make the Attends line of products, which I didn't know they own that brand. And then recently they just acquired a diaper company. So that kind of goes in with the same type of business, but it's going to be accretive to earnings going forward, but not in a huge way because it's still a small segment of their business. But they are expanding in that area, so analysts like it. This is kind of a turnaround story. They missed big in the first quarter. And so you can see, I put up the chart of estimates. They really came down in the last 90 days, but now they're starting to trickle up again because the pulp prices are holding and there's some good things going on here. So it's, analysts are expecting a little bit better going on in the second half of the year and into next year. So you are playing the turnaround, like I said. Shares really down. This is like one of the few charts I've seen like for this year where shares are off, double digits. But that's what makes it a value stock too, because you're getting in after all the bad news maybe has been priced in. So they're trading around 13 times. Their price to book is really low. It's only at 0.8, and they have a really low price to sales ratio too of 0.4. Anything if those are under 1, that's, you're talking a real undervalued stock. They also pay a really good dividend, 3.2%. So you're getting, a decent chunk of change to hold on and wait out all these issues that are kind of going with them. But like I said, the analysts are looking for a turnaround coming in the later half of this year.
All right, we'll have to see, maybe there's a follow-up down the road.
Maybe.
Do you own either of these two?
I do not.
All right, check out other stock picks on our website, Zacks.com. If you're not there already watching this video, get on over. They change often, so check back often. With Tracey, I'm Terry Ruffalo.